Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 20th of 2025. Have quite a bit to get through today, so bear with me. We'll start off with the GDP Now estimate from the Atlanta Fed, which, as I've mentioned many times, does a really good job of predicting where we wind up on a quarterly basis for GDP. And so their estimate for the first quarter now is basically about flat. Now, they had been looking at negative numbers not too long ago, beginning of this month, and it looks like they're kind of coalescing on roughly zero here, as you can see. And the consensus, which is outlined in the blue with the average here, is also trending down as a result of tariffs. And we're going to spend a lot of time today talking about potential impact of tariffs. And we really don't know because the news flow is changing on a day-to-day basis. And I'm not even sure the administration knows what they're going to do from one day to the next because this news flow is so fluid. But we have to kind of gird ourselves to what might be the case, and we have to manage our portfolios basically in recognition of that risk. Here we have some data on trade negotiations. This is from Apollo and Torsten Stork. This is really good work here because it shows us that on average it takes about a year and a half to sign a trade deal, and these are trade deals that have been signed by the United States. And you can see here in the launch date to signing, or basically, roughly that 18 months that they're talking about. I mean, that falls in line here. And some of these obviously take a little bit longer, but then beyond that, it takes another 45 months to implement. So when you think about that in terms of years, that's almost 4 years to implement. And so these things, while it seems in a vacuum like, you can cut a trade deal or whatever, and everything's moving so fast right now, and even these conversations with Japan, Italy, and Vietnam offering 0 for 0, basically trading no tariff or no tariff, these are just starting points for conversation. These things just inherently take a while. Here we have a share of Chinese exports to the U.S. So if a lot of this tariff stuff goes away and the administration is realizing the impact it's had on the market, and you can clearly see how they've walked back some of these goals that they've had. But the one that's going to stick and has stuck for quite some time is the Chinese tariff. And you can see here that very clearly, going back just a few years, you can see the share of Chinese exports that are actually going to the U.S. has dropped by like roughly 6 percentage points. And, in terms of aggregate trade, you talk about 500 billion. I mean, you talk about the aggregate trade internationally, and you talk about the bilateral trade between China and the U.S., that's a really big number. And what we're seeing here is a lot of those Chinese exports are going to peripheral states. We'll see this in just a second, which ironically, even as production has been moved out of China to places like Vietnam, that Vietnam's trade differential with China has gone up. And so a lot of these materials that are being sourced out of Vietnam are actually coming from China. So here we have a change in share of U.S. goods imports. So you can see here, we mentioned 6 percentage points, and this is just like where you decide to mark your starting point. But basically 5 or 6 percentage points of Chinese exports going to the U.S. And so the difference is, a lot of those have moved to Vietnam, and you can see here our two biggest trading partners, Canada, Mexico. You can see that where Chinese trade has gone down, the trade with these other trading partners has gone up, especially Vietnam here. And you can see here, this is China's share of goods imports for biggest gainers in U.S. market share. So you can see here, this actually comes to us from the Federal Reserve Bank of St. Louis, some work that they did. And you can see that these same countries are now like receiving perhaps bigger shares of trade with China, even though U.S. has fallen off. But ironically, you're getting a lot of pass-through of what originates in China into the U.S. through some of these other trading partners. Here's a chart that is likely to change pretty regularly based on the news flow out there. But you have the dark blue, which is the tariffs as they stood a year ago. And that you can see here, some, particularly leather apparel, textile, and textile products, probably have some of the heavier tariffs, as does fabricated metal and like hot rolled steel and things like that. But you can see January through March, there were additional tariffs that were discussed. And then you came out with the April 9th announcement, which is kind of that follow-on to the Liberation Day or whatever you want to call it. And this is the magnitude of that change. Again, these are proposed. I mean, there's been a moratorium put on this, and I think a lot of it had to do with the fact that the inner workings of the administration. Your trade hawks were out of the office that day, so to speak, and your Treasury Secretary and your Trade Secretary, Besant and Letnick, both convinced President Trump to put a 90-day, really a moratorium on those tariffs. But if they were to be implemented tomorrow, that's what they would look like, and that's really pretty strong there. And I mean, when you get tariffs that are 75, 100%, it really is a disincentive to transact, and you're already seeing airplanes from Boeing that are being returned back to the U.S. You're already seeing ship containers that are being told to turn around, and I think it's just a matter of time before what we see in the soft data, which we're going to take a lot of different looks at here. Soft data translates into hard data, which I don't know that we've really seen yet. And again, I think the transition of the soft data, which are the surveys and what people think and sentiment and all that, and how that translates into hard data, which is actually goods purchasing, retail sales, is actually what people do with their money. That's going to matter a lot on whether we get this or not. Okay, well, suffice it to say, this is also from Apollo, but suffice it to say that these are the headwinds that we're dealing with right now. I mean, the biggest of which is tariffs and the unknown that it brings, but you've got a lot of uncertainty about, are they going to happen? Are they going to be permanent? And then we've already kind of talked about retaliation and how that looks. And, China's retaliated to our 45% with 125% tariffs. And it's just like, it seems abstract at this point because, like I said in the last slide, you get over 75, 80% tariffs. I mean, you're really not even going to transact that good because it's just simply too expensive for you to want to buy anyway. And that's well above a level where shippers and freight forwarders are going to be willing to accept that cost and kind of have a hit to their margin. And then you've got these other things, tourism, confidence. We're already seeing that in some of the soft data. Corporate confidence, clearly in the data. Negative wealth effects. Now that's coming up later, and B of A did a study that showed here with the stock market decline that is very much in play here. And then as we started talking about, like almost from the day after the minute new administration took over, is we've got Doge and the impact on government workers. But this is the headline. These are the sets of headlines that are weighing on the economy right now, and of course weighing on the U.S. stock market, and to many respects the global markets right now, just because of the interrelatedness of the U.S. market to the rest of the world. Here we have the Economic Policy Uncertainty Index, the Baker, Bloom, and Davis. No surprise there that we're seeing a really big shock to the system, which is every bit as big and perhaps maybe even a little bit bigger than the shock that we had in policy uncertainty around the advent of the pandemic. Here we have some data, again, from Apollo, just looking at the ramifications if you have interest rates, which are now very much expected to go down, although they've gone up lately, and we'll have to talk about that later. But if they do go down, you get a 2 percentage point decline in interest rates, hypothetically. Then the positive impact on your economy from having lower interest rates here is more than offset, like more than 2x offset by if you do go into a recession, Again, the administration feels if we have some pain and go into a mild recession or whatever, and interest rates come down and we get more tariff revenue, then it all evens itself out, and that's just not the case. Based on Apollo's research, and I've seen other research which looks very similar, but if you have government spending, which is a meaningful part of the GDP equation, and you have an erosion of government finances, meaning that you have to borrow more to fund increasing deficits, then that has a much more adverse impact than the benefit that you gain from lower interest rates. So now let's talk about capital spending, and business equipment investment is here in this red line. And so estimates from Oxford and Haver here show that if things don't change, if things remain as they are, tariffs go into effect as they are, then you're going to have a significant drop in investment, and because obviously the uncertainties and the expectation for slower growth. And where does that happen? And it happens in a lot of these key areas. And so when you think about business plant expansion and capital spending, well, what do you need for that? Obviously, you're buying machinery, trucks, you're buying computers, you're buying a lot of different things here that are capital goods. And you can see here that the potential impact of tariffs on these goods, whether direct or indirect, is actually pretty respectable. Anything like say between 10 and 20% is going to cause you to want to pull back, and that's exactly what's represented here. That even you have consumption that goes down too, and that's the follow-on effects of having a tariff. Things get really expensive for a short time, and then people just stop spending as much because they just have a fixed amount, and the Federal Reserve right now is pulling money out of the system, not putting money into it. So we have exactly the reverse effect that we had during the pandemic with the explosion of fiscal stimulus and whatnot. And so that's what this is talking about, that there's going to be a multi-year period where growth in capital spending is going to stall if you have the tariffs of this magnitude. And so again, I'm a bit of a skeptic, because if anything, Trump follows the headlines and sentiments, and if he sees that polls are shifting, which they already have, and his job approval rating sinks to points unknown, where they seem to already be heading. Again, not waxing political. It's just this is his MO, that he will reverse course and change things. So I do feel like maybe this is kind of the worst case scenario, but it needs to be discussed. Okay, capital spending we've talked about already, and the key impact here, and one of the reasons why we pared back small cap exposure during the interim here, is you've got overall private fixed investment here in this green line, and then you've got the S&P down here, and both of these lines, particularly going back to the pandemic, have gone up. But this delta right here represents small businesses. So small businesses account for 85% of total capital spending in the U.S. economy. And as we just saw, if you're going to curb capital spending, that's going to come largely on the shoulders of small business. Here we have a chart with employment in firms less than 500 workers. We know that number in this country is about 110 million. And so when you look at small employees, and that's represented here in the 1 to 49, and you've got, again, pandemic aside, you've had that number rise, and obviously we've talked about labor participation rates and things like that, but obviously small business matters very much here, because you have far less employment overall, and these are millions in millions. You have 25 million people in the large employer category, but you have a whole lot more in the small and medium-sized business category. Consumer sentiment, as we've already said, we see that dropping here. We see it, basically returning to levels that we were at, like, call it in the middle of 22, which is very, unarguably a tough place to be, because we had very large inflation here that we're trying to work down, and markets were certainly reacting to that and rising interest rates at the same time. But you can see here clearly a markdown in sentiment, both in the cohorts with people less than $100,000 a year of income, and also with those greater than $100,000 a year in income. And those are the people that constitute the majority of the spending. So consumers are worried about losing their jobs. You rarely see something that moves vertical like this in fairly short order. Of course, it has happened, but as you can see here, oftentimes it tends to correlate with recessions, which are these gray bars. So not saying that we're going to head to a recession, just saying that, when we were, talking last fall, even heading into the new year, we had a very strong labor market. We had good sentiment. We had good outlook for capital spending. We figured that we were going to get probably a lot of attention on immigration and other policies. We knew that we were going to get some tariffs, but we didn't know that the administration was going to really jump in with 2 feet and both arms on tariffs, which have caused us to change in fairly short order. But suffice it to say, we had a good economy that had some natural slowing and natural rate of growth kind of curtailments in place before these tariff announcements were made. On consumers, this is basically a sentiment. This is one of those soft indicators that I mentioned here. And then conditions 1 year, worse. This goes back to 1980, so it has a lot of data to look back on. But we haven't seen a number like this in this entire series. Not even going back to 90, not even going back to the tech bubble bursting, and oddly enough, not much more. I mean, we didn't see anywhere near where we are now back in the global financial crisis, and that does surprise me a bit. Okay, households expecting worse financial situation. Now the last slide was business conditions. This is financial situation, which is a different definition, but also moving higher. Significant decline in income is now expected, and you see the magnitude of this drop. Is very precipitous. Again, not usually seen unless you're in recessionary periods. Inflation expectations with these tariffs are also moving higher. Again, a lot of these are soft indicators. It's what people feel. They read the headlines, and generally headlines don't get published unless there's bad news. You rarely hear headlines that talk about everything that's good in the economy or in the markets, but you always hear about the bad. And so a lot of negative press on tariffs is causing a lot of the sentiment and rapid change in expectations. Here we have the dollar index. The dollar is moving down, and you can see this diffusion of the dollar since 2005. So this represents a dollar movement year to date for every year since 2005. And as you'd imagine, as you get towards the end of the year, you get that cumulative dispersion. But this is you can see the magnitude of the drop here. Again, if you draw, 2 parallel lines, you can see the line of best fit is kind of like in this channel going back to 2022. But we have clearly punched through the lows and actually punched through the low that we saw in 2023, and now we're back at 2022 levels. And you can still see that here, and you can see that there. And what this is doing is helping to prompt some changes in our overall kind of investment landscape, because we've benefited from a lot of foreign ownership of U.S. assets, and that has really taken off over the last couple of years. And so, the oddity when the stock market was going out and these inflation expectations were moving higher and economic uncertainty was moving higher and all of this, you would have expected prices for a fixed income and particularly treasuries to go up as there is a demand for safety, a flight to quality, But what actually happened is stock market sold off and the bond market sold off and yields went higher. And some of that has to do with foreign investors loosening up holdings of U.S. Treasuries and creating an increased supply, which thereby depressed prices probably more than what would have been the case. And lower prices means higher yields. So that's really what happened there. But dollar moving down, good for, the energy basket. You've got a lot of commodities that are priced in dollars. So if the dollar moves lower, that typically bodes well for commodity. It bodes well for foreign markets in the commodity market, not necessarily for, U.S. Not necessarily for the U.S. Here we have the New York Fed Services Index. You can see that's moving lower. Outlook was resoundingly positive for quite some time, and that's moved lower as well. We have Empire State, which is the New York Fed. You can see that, oddly enough, it moved higher, and it was better than expected. Now we have new orders, expected in 6 months in the pink. That's clearly moved down. And then you have prices paid, which is already and continues to move higher. So we've actually seen that in the data, and it's also expected to continue to increase over the next 6 months. So we did get retail sales here, and the number was pretty much in line. If you back out autos and gas, a little bit better than expected. You see it typically goes up, but we have notable down periods. We're riding a wave right now. The consumer is still spending, and that's positive. Now, if this starts to trail off and go negative and continue to be negative, then we're going to have to reckon with that because that will be an issue. We did have a negative print here in the overall retail and food and services number, but by and large, it's been very positive throughout the last year. Average price of ground beef. This is just but one proxy for what we're seeing. And there are different reasons for different baskets of food. Eggs obviously had kind of a bird flu and kind of a virus issue, which herds and flocks had to be euthanized or whatnot. Beef prices moving higher, is just and this is a consistent trend, but you can see the more recent acceleration there. So this is the 30-year fixed mortgage rate. We've talked about interest rates kind of moving a little bit higher, and as a result, we've seen an increase or an uptick rather in the 30-year fixed rate, which has moved up about 20 basis points from the last time we showed you this. Holding in, I'd call it like a, basically 6.5 to 7% channel here, but obviously reflective of overall interest rates and making it still a little bit harder on the affordability side for homeowners and particularly first-time home buyers. Here we have industrial production ahead of the tariffs, people getting out ahead of it and acquiring more goods and maybe making advanced purchases and getting them on the boats and getting them shipped before tariffs really set in. So I'd say this is something that was pretty widely expected, but we'll have to wait and see if it begins to really erode and turn negative. Here we have debt to GDP. The debt to GDP ratio continues to move higher. This is something that's getting a lot of press, as it should, because the last time we were this high in terms of debt to GDP was World War II and its aftermath. And we worked very hard to get that debt to GDP down. And in many cases, it's because we had kind of the 50s boom, if you will, and the baby boomers getting into the working world and productivity moving higher and so on and so forth. And so, but right about 1980, when we were basically fighting in the Cold War, and we increased our military spending and the debt and deficits went up. brief time during the Clinton administration when they went down, and then obviously with 9/11 and then COVID, we see what we've got now. So this is, in my view, not a sustainable track. We've got to somehow figure this out. But the other line here, which I haven't talked about yet, is a 10-year yield. And you can see that there's some reasonable inverse movements here. And so the 10-year from 1980 during the continental Illinois and the peak of inflation, and then we had that secular bull market, which lasted basically almost 30 years before we've seen that trough. And so what you've got here is a case where maybe your debt to GDP goes down, maybe it doesn't, but this would certainly argue for 10-year yields that would be materially different than where they are now. Global forecasts are also coming in for other areas. We've got global GDP, those estimates moving down. China, those estimates have been massaged quite a bit, but basically flat to down. And then US, we've already talked about with the Atlanta GDP now, and then Eurozone has continued to come down. So when you talk about in the aggregate, you're talking about plus territory for the US, and you've got very anemic growth in Europe. China is not 5.5%, 6.5% anymore, but it's still 4.5%. And then global GDP you see here down around 2.4, which is modest downtick from levels that we've seen consistently over the last several years. A really busy chart here, but this represents fund managers, their thoughts on where we're going. And you can see in this line here, call it kind of this weird aqua green color here, but stagflation is all the rave right now. That number peaked when we hit 2022, consistently went down. We thought we'd get more of a boom, but that's given way to stagflation. So again, sentiment, whether you're a consumer, whether you're a fund manager, it's really not that good right now. But I will hazard that these are the times that you need to be eyes wide open and looking for potential opportunities, because these sentiment indicators can change pretty quick. Got a couple of charts on private capital. Interestingly enough, we've got fundraising, which has actually gone down for buyout sleeves, and that's kind of a global number. We do have a lot of limited partnerships and a lot of vehicles out there that have a lot of ownership interests that are looking to sell, and we're looking for more exits. Now, the feeling is maybe 2025 presents some opportunities, at least maybe for more acquisition, but this is fundraising. It'd be interesting to see what the appetite is for new money coming into the private space over the next year. Looking at this, it really just applies to the Austin metro area, and since we do have a lot of clients here, what's really interesting is that we've had a real spike in funding, and this is going to be a banner year for Austin. And there are other parts of the country that are benefiting, other parts of the country that are not. But when you're looking at kind of health in private capital, you clearly see it in Austin. You've got increased deal flow, and some of these deals are quite large. In fact, deals that are actually registering on the national stage as well in terms of their rank and size. So Fed funds, this is short-term interest rates with all the goings on in the markets and the news flow, are now pricing in a full 93 basis points, essentially 4 rate cuts this year. This is a year in 2025. Market pricing for Fed funds now around 3.4. So again, we'll have to wait and see how this all plays out. Oftentimes these projections are wrong, but just not too long ago, we were struggling to price in more than 1 cut, and that has changed very, very dramatically. So we talked a little bit about negative wealth effect, and this will get your attention. So you think about the size of our markets and the dislocation in prices now. Again, no one expected the magnitude that we got, although I have to say that we were actually very much overdue for, a pullback, and not sure that we were necessarily due for a full bear market, which we had in some indices, but nevertheless, recognizing we have more individual ownership, recognize that we have more foreign ownership of U.S. Equity holdings. You can see here that the wealth effect that's projected to be in play here for the first quarter when those numbers are released could be very impressive from a size standpoint. So here we've got earnings estimates. This is a Citigroup survey or sampling, I guess, of S&P 500 earnings, and you can see that they have continued to be ratcheted down even before all this tariff stuff played out. But you can see that estimates are coming down, which I thought was healthy, because I think when we were right here, I thought estimates were too high, regardless of what I thought about tariffs, but were too high anyway. But in many respects, they are coming down, and you can see here in this Sherwood data point here, the worst net earnings revisions since the pandemic, and you can see that very large downturn right there. So 3-year stock and bond correlations. These are rolling correlations. I've talked about a lot how, at various points you get actually very positive correlations. And well, you don't want that if you're trying to use fixed income to diversify the risk of your equity holdings. And so, with the recent spike in this, and again, there were many years where that was the case, but here, I think it's a kind of a call to action, because you have to think about equity and fixed income differently. You have to think about finding ways to get uncorrelated returns, because that's how you lower your overall risk. And so there's been a lot of criticism over the traditional 60-40 model, and how bonds are actually helping or attempting to help, but are actually hurting or contributing to volatility in some cases. We still have a differential between growth and value, and this chart is a little fuzzy, but I'll interpret it for you. So the average PE ratio for growth is about 23 times. Well, we're currently priced around 29 and a half. So we still are well above, or I'd say materially overvalued. And then when you go to pure value, the average is about 12 and a half, 12.8, and we're basically right there right now. So value stocks are pretty much in line with their long-term valuation. And you see here, growth stocks are still overpriced, even though those numbers have come down a bit. Term premium. So we were talking about interest rates moving higher. Well, you can see here in the term premium, so you're getting farther out on the yield curve and you're seeing higher rates. Well, again, some of it, may be a reflection of kind of the brand impact on the US dollar. If you have uncertainty in your trade policy and your trading partners begin to maybe slowly move away from US based and US denominated, dollar denominated investments, you could see rates higher because of that, which would offset any kind of like economic weakness to some extent. But the uncertainty factor is making investors command a higher term premium, and you can see that in the 10-year Treasury right now. Japanese residents here are buying less treasuries, and you can see that number is moving down pretty rapidly. And for the reasons I mentioned before, you've got dollar-denominated assets which are hurting because you've got a very weak dollar. And there's a lot of different reasons why the dollar's moving. There's a confidence factor and maybe even a long-term brand identity factor. But one example of where foreign investors are moving lower in terms of their net exposure to U.S. assets. And as I've mentioned several times, you've got foreign ownership that's pretty high. Now, this is particularly of the Treasury market, and you can see here that over time you've got basically the rest of the world here that has increased their share of ownership. Now, that may have come in a little bit overall, but still, you can see that that's a very strong cohort, and you have to understand what the interplay is when you make policy decisions on how that could or impact, rather, probably a better word, but impact foreign demand for your assets. So bid-ask spreads are widening in investment grade credit markets. Again, this is from Apollo. This just reflects risk, reflects uncertainty, and it reflects a fact that if you're not buying liquid securities here, which is in the green, so these are bonds, investment grade bonds that you could do price discovery for. You could look up and see where they're trading with variant market makers in the market. Well, those are still in demand, but when you have spreads that widen out in basically private bonds, that tells you that the market is drying up, at least for the time being. We've got the S&P 500 to gold ratio. This just really speaks to the strength in gold here at a time where the S&P 500 is struggling a little bit. So, but usually this would be an indicator to buy the market. And you can see here back in the pandemic, we had a pretty sizable near-term change, and then we've had some terrific performance out of the S&P 500. That is really almost more than matched the rise in gold. But here we have the copper gold ratio in kind of this purple line, and that's overlaid against a treasury yield. Again, we've talked about reasons why treasury yields may be abnormally a little high right now, and based on the fear that we're going to go into an economic slowdown. But really what this tells you is that copper to gold ratio that's reflected here and moving lower and because gold is rising at a faster rate than, or stronger in terms of its financial performance versus copper. But what that tells you is that interest rates, particularly 10-year yield, should be at least I'd say at least 2 percentage points perhaps lower than where they are now. So we were talking earlier about the ability of the kind of the 60-40 portfolio to offset equity market turbulence. And you can see going back in history, this is Treasury's cumulative return. And this goes back to 1984. This is just a kind of a near-term representation of that. So it's basically looking at this time period in isolation. But historically speaking, I mean, you've had positive performance positive performance out of treasuries at times where the equity market has really sold off and has been negative. I mean, you were consistently rewarded for that level of diversification. But when you go to this little microcosm right here and splash it up on the screen like we've done at this point, you can see it really hasn't helped as much. You can see these times, I mean, you had like multi-year, performance that really helped you in the diversification strategy, but you don't have that now. In fact, you've had times where you've had significant fixed income drawdowns at the same time that you're having equity drawdowns. And again, this is 2022, which for me was one of the most difficult years to manage money that I've ever seen, because even back in 2008 when markets cratered, you had treasuries moving higher. And so that seems to have broken down a little bit. And again, it's just a call to action to find better ways and more innovative ways to get diversification. And some of that, may lie in the private markets. That's all we have for the chart pack today. I hope you've enjoyed it. A lot of data to sift through, a lot of moving parts to the overall macro story right now, but we're trying to keep our finger on the pulse. Please call us if you ever have any questions. We're here to help and hope you have a wonderful week. Take care.